It's Cash Flow Cart. Today we have a very exciting video, guys. First off, I do want to, kind of address something. So I do want to apologize. I have not been, near as active on the channel as I've kind of set out to be. And we're going to get into, a few reasons behind that. With the holidays and stuff, I wanted to take some time off to kind of just focus on family time, kind of unplug, not be on my laptop every single trading day. So that was kind of the first factor. Took some time off starting in November for Thanksgiving and stuff. And then continued for some holiday time off through Christmas, everything. As well as some personal stuff. Some stuff in my personal life, and as well as being busy with work. I want to put it this way, and again, I apologize. Just not having been in the mood to turn on the camera and film YouTube videos. With that being said, I still very dedicated to this portfolio, very dedicated to the game. Matter of fact, when you guys see the portfolio update, it's going to be oh my God, he's been overdue for a video. Yes, I am overdue. But like I said, just, past 2 months or so, haven't really been in the filming mood. But we are going to get back on track in 2025. Probably going to try to have this come out in February and then return to the regularly scheduled one video a week program after that. Okay, guys, sorry for all the yapping, but let's get into it. I'm very excited to share with you guys this video. The 2025 Dividend Portfolio Review and Outlook. Let's go for it. You guys will, need to brace yourselves. We have made some changes. So looking at my portfolio, guys, the estimated annual income is now $2,967.62. This is an all-time high, okay? The monthly average breaks down now to $247.30. Guys, I've been talking about that $3,000 income mark with the $250 monthly average has been my goal. We will hit that relatively soon. And as you guys can see, in February, I'm projected to make $110 from dividends. March, $292. And then April, $340. Just because of where I've seen opportunity in the market, the income breakdown quarter to quarter has gotten, pretty choppy. Guys, if you're in a similar case like this, do not stress about it. Try not to worry about, I make way more in this month than next month. It's really not that deep, because when you do get to the point of kind of living off these dividends, you'll be able to kind of take out the income as needed and kind of create the smoothness that way. Okay, so moving on, let's get into it, guys. This is going to be quite the shock, and honestly, I'm still kind of a little shocked about, the way the portfolio has shaken out. So coming in at number one, guys, we have Altria Group, ticker symbol MO, at 250 shares, market value of $12,760. I mean, this one's been my number one for a couple months, and I'm kind of happy it's there. It's nice to see that it has kind of started consistently closing above the $50 mark. I'm definitely not buying it now. I was much more interested in buying Altria in the low 40s, hence building out this $250 position. And now I am kind of being rewarded in the sense of, some capital gains on it. So that one pays me estimated $1,020 annually. That is my highest income earner. Moving on, guys, we have Realty Income Corporation at 215 shares at a market value of $11,431.55. guys, this one's done well for me. However, we consistently have talked about me not necessarily having the best cost basis on it. Okay, so I'm in it at an average price of 65, and in theory, I should be, picking up shares as it kind of looks to be bottoming here. I should be driving down my average price, driving down that cost basis, locking in more income. But, big lesson here is if I already have the position built kind of to my number 2 spot, it kind of becomes a game of how much more capital do I want in this one? How much more real estate exposure? And, are there better opportunities and better uses of my capital? So, it's not going anywhere. I probably should try to pick up a few more shares. But, at this point, you got to play by your bankroll. Then you got to allocate your capital to the best opportunities. Moving on, guys, Hershey. I'm really, really excited about this one. It has continued to fall. Ticker HSY. I have 70 shares for a market value of $10,622. Currently paying me $383.60. So, if you guys have been with the channel, you've seen how fast this one's grown from, the smallest guy to now the number 3, kind of one of my big 3 payers at this point. I'm going to be very much looking forward to continuing to build this one out, okay? And we are going to talk strategy and kind of my strategy for 2025. But as you can see on it, even when I started buying in this consolidation here, Hershey has even broken down and continued to fall lower. That is going to drive up the starting yield on this one, as well as, earn me more bang for my buck for every share I can lock in. Again, we are in a similar boat here, though, where I do have to be careful, getting too much capital involved with it. And if it continues to fall, could be in kind of a situation I am with Realty Income where I don't necessarily want to continue buying, but, I'm going to be a little less cautious with Hershey. We'll talk strategy in a second here, guys. Moving on, Apple. As you can see, I have 40 shares of Apple now, ticker AAPL. And, month to month, you guys have seen me trim this one. I think when I started the channel, I had 63 shares of Apple, and then I think I trimmed to 50, and then I think I trimmed to 45. And then since I've been with you guys last, I have gone ahead and trimmed this one to 40 shares for a total market value of $9,514, paying me estimated annual income of $40, guys. These 40 shares are here to stay, and I do want to visit kind of, what my exits have looked like. So like I said, we were at 63, took off 13, got down to 50. Took off 5, got down to 45. And I've since taken off another 5 at $233 and change. A very similar exit fill to the previous trim. So you might say, oh, why did you not just take off the 10 there instead of doing 5, kind of waiting and then doing another 5? And the reason for that is because of, the opportunities I've seen in the consumer staples sector have just gotten too good to ignore, and I'm kind of not necessarily wanting to build some of these out super slow. Like you've seen with Hershey, how fast relatively this one has been built out. And we've also seen incredible performance from Apple and Microsoft, leading me to trim, and then trim some more as I kind of rotate capital into, in my opinion, screaming buying opportunities. Okay, hopefully that wasn't too much. I did take off 5 more of Microsoft as well. Okay, so we see this overextension on Microsoft. We see it on Apple as well. And Fortunately, I've been in a really good position with some of these other buys to lock in some profits and kind of rotate slowly the portfolio, not out of tech fully, but away from tech and into, kind of some sectors I see more opportunity. Okay, so that might have been a lot to digest, but moving on. Next up, we got Pfizer at 262 shares. That's coming in at $6,869, guys. And that estimated annual income is $450 and change. Okay, again, you guys have been with me. You've seen kind of the moves on Pfizer, trying to kind of average in and lock in kind of the position size I'm comfortable with through this rounded bottom. We get the reversal. That's kind of like ideal dream situation. Okay, we lock in this position while we're undervalued. Pfizer returns to, more of a fair value. I have the, starting yield on it as well as capital gains unrealized on it. That's kind of what I want to happen. I don't necessarily see myself buying too many more shares of it. I think I would be very happy if I could get it to 300 shares even. But again, we'll have to wait and see. It's kind of proven to be a little bit slower mover. So again, I'm not really in a rush on it. Moving on, Starbucks. I'm just going to go ahead and say, for me right now, Starbucks is I'm kind of done touching Starbucks. I'm at the 70 shares. Maybe at some point take it to 100, but this is like very much not a priority for me right now. I don't want to trim it. I don't necessarily want to add to it right now. I'm kind of happy with it being, a small, medium position at the $6,515, paying me $171 in income, guys. Moving on, we got Microsoft, MSFT. We just talked about the trim on it. We could sit here and kind of talk about the tech rotation, but this video is more of a portfolio review. So I think I will go ahead and save strategy for like an upcoming video. Okay, sorry I kind of, breezed through that first part of the portfolio, but, if you've been with the channel, it's looking pretty similar to what it's been. I mean, you guys know this is kind of a slower moving game for me. There's more shares of Pfizer now, more shares of Hershey, less shares of Apple, less shares of Microsoft, but you've kind of seen, kind of my thought process. And, real quick before we move on to this next guy, I do want to say my intention is not necessarily to trim many of these positions. However, the outperformance of Apple and Microsoft as compared to a lot of other stocks I've been interested in has led me to kind of trim, I'd say a little more aggressively than I ever even anticipated. And it does come at the cost of locking in, long-term gains. Like I've said before, I definitely will be paying my taxes out of pocket. I'm not going to, dip into my portfolio. I think that's dumb. So it is going to come at the expense of paying long-term capital gains on kind of my trims on Apple as well as Microsoft. But, I mean, that's okay. This is strategy I'm pretty kind of, I've been doing it a long time. I understand when it's time to pay tax on gains, it's kind of an inevitable thing. It's my choice to use an individual account rather than an IRA or something along those lines. But death and taxes are the two certainties in life. You know what they say. But moving on, very, very exciting stuff, guys. We have a new position in the portfolio, one I've really had my eye on for a very long time, and that is PepsiCo Inc. I mean, even as far back as even as far back as like late 2023. I mean, I know the channel's kind of new, but I was doing like Pepsi, Coke comparisons. Probably should kind of revisit that video at some point. But yeah, ticker PEP has joined the portfolio, and I have 21 shares for a market value of $3,040, paying me an estimated annual income of $113 over the next 12 months. Guys, I do want to talk about real fast. I will have kind of a full Pepsi video come out, but real fast, I kind of want to explain my strategy on it. I'm not going to get into valuation metrics. I'm not going to get into financials today, but I will kind of release a fundamental video on it at some point. I want to talk big picture today because this is, a big picture portfolio review type video. So, this is a chart I've revisited kind of my whole time I've been investing. And I really like this chart. It shows the S&P 500 sector performance. So by sector, it breaks down the performance as well as putting, kind of in gray the S&P. Okay, does that make sense? And the purpose of showing you this chart and kind of how this chart has helped ground me as an investor is it really kind of puts in perspective that you're going to find, the interesting stocks, the better opportunities year after year, kind of based on clearances in different sectors of the market. Does that make sense? So what I mean by like a clearance sale is this, okay? If a certain sector is underperforming, okay, it might be more worthwhile to kind of, shop for stocks in that sector. Okay, you revisit your watch list, you kind of see what stocks, align with sector underperformance. Does that make sense? And for me, and we've been talking about it, it's been consumer staples as of late. So we can see 2023, the only two sectors performed worse than it were energy and utilities. Okay, I still think I'm a little young to start going this direction. Probably a lot young. I don't know when I'll kind of get to that point of energy and utility investing, but we will see. I'll keep you updated. As well as in 2024, consumer staples was one of the worst performing sectors. Again, real estate, I have Realty Income, healthcare, we've talked about the Pfizer buy, but consumer staples has been, kind of a laggard in the market. Does that make sense? And with that being said, you've seen how aggressively I've been scooping up Hershey shares. I mean, it's like it almost just keeps getting worse and worse. And as a dividend investor, that's kind of what you're going to want to look for, okay, is solid companies with long-term track records that are underperforming in a massive way, okay? You kind of find this undervaluation and it takes some conviction. You build out the positions. Okay, that's kind of what I try to do. We will go to the Pepsi chart here just to kind of drive this point home. So, real fast, Pepsi's one that's been on my watch list for, a long time. Okay, like a very long time. I guess it's all relative. 2024, 3, 2, 21. So 2020 is this year here, kind of this shaded area. Okay. I start kind of watching this double top in 2020. It breaks out of that double top in 2021 and kind of goes for a run. This is a stock I'm still interested in, kind of kicking myself for not having the capital here in 2020 to build out this position in Pepsi. But, just kind of one that goes on the watch list. And I end up making, kind of this double top as a level on my chart that I'm interested in picking it up. Last year I put in 144 question mark. That kind of was the level I was interested in adding. And then what do we see? Finally, feels like it's never going to happen. Pepsi finally falls down to this 144 level. It has broken down that support. So it may go even lower in 2025, which would be something I would, welcome with open arms. And so, yeah, this is just a situation where Pepsi was on my watch list. It kind of finally reached the level to me where it was a screaming buy. I was able to, lock in some profits from some overperforming stocks in my portfolio, by the way of Microsoft and Apple, and kind of begin this position. Okay, so that was a lot of words. But as you guys know, kind of I've been building Hershey. I just started Pepsi, and we will touch on more strategy stuff during this year, but I kind of feel that Hershey and Pepsi are going to be kind of my focuses for 2025. Okay, so it is interesting. I've already got the Hershey position, built to my number 3. I would like to take Pepsi in that direction, and I would really like to kind of overweight this consumer staples sector right now, kind of with the expectation and understanding that this is a long-term game. I will have time to revisit tech. Hopefully I see kind of my healthcare allocation naturally come up with Pfizer. But like I said, 2025 for me is probably going to be about consumer staples. And it's looking like my attention has been turned to Pepsi and Hershey again. So with all that being said, guys, thank you so much for watching today's video. I know it was kind of a little jumbled. I don't even think I talked about T-Row. But, we will. It's kind of my smallest position. Pays me $75 a year. But, guys, thank you so much. I hope I don't seem too rusty. I really, really appreciate your guys' continued support. Like I said, I haven't been in the mood to turn on this camera and get behind the camera. I have not been in the mood to turn on this camera and film a video, but, I've been nonstop working, day in and day out to kind of finalize my strategy, kind of decide what direction I'm going with during 2025. And I do want to keep you guys updated. I will continue the content, guys. Thank you so much. Please subscribe if you're not already. And everyone have a great day. Let's build wealth.